Well, good morning, everybody. It's 10:01, so we'll get started. John, we were talking before this video. There's hasn't been a ton of kind of altering news like we've been used to each week leading up to today. Markets were down a little this week at various points. Now they're up a little bit today, depending on which index you're looking at and what time you're looking at it. So we've been reading that volatility is back, but not wild volatility, just some down days mixed in with the up days, it seems. So what we thought we'd talk about today was what news did come out, what kind of recent things we're doing in our portfolios, and also Jonathan wrote an awesome quarterly letter that we will be sending out to everybody this afternoon. So teeing up some of the content in there as well. So I think top of my mind, Jonathan, is yesterday unemployment numbers were updated. There were some headlines saying they were better than expected, but there seems to be some question over the calculations and who's included in that, and if people are underemployed because they're working for Instacart or something along those lines. But that total unemployment numbers are now around $50 million. What's your kind of take on unemployment numbers, and why aren't the markets more concerned about it right now?
Yeah. So the first real unemployment upside came last week, actually, with the non-farm payrolls Friday, and it showed that the unemployment rate wasn't anywhere close to 16%. It was actually 11%, and at a net addition of jobs last month versus a loss of jobs. So that really surprised everybody, because economists were expecting a loss of 10 million jobs last month, but we ended up, I think, with a net gain of like 2 million.
Mm-hmm.
They missed by the widest margin ever, and it had a lot to do with how they were classifying and how they were counting people. So people that were partially employed, weren't really counted, or they left out some other groups. There's timing that starting to be discrepancies between how many people the non-farm payrolls report says are unemployed versus the number that are claiming unemployment checks every week.
Right.
Claiming unemployment checks every week, then the Bureau of Labor Statistics says they're people.
Wow.
Yeah. With last week's report, again, depending on how you classify things, the numbers will look different. And I think because things are changing so fast, and the CARES Act is a new policy that's coming in, so people don't really know how they should account for these things, and there are ways. We can't really look at the number and look like, oh, it was a beat, that's good news. It was lower, so it's bad news. I think the most important thing is to look at the trend, where things are going.
Right.
So this week's number was pretty well. Surprise to the upside, it was lower than the last few weeks. But what I think is interesting to note is that was last week. Now, moving forward into the next 2, 3, 4 weeks, we're seeing that many states are pulling back on their reopening plans. Had more companies come out and say that planned layoffs. United Airlines came out earlier this week, 6,000 people in the fall. And Wells Fargo is planning for thousands of furloughs in 2020. So we will see how this develops into the year, and we'll keep a close eye.
But what we've seen recently is that consumer spending still seems to be quite strong. So why do you think that is?
Right. So, and I talk about this in the letter, which is, despite 40 million people being out of a job right now, the world would typically, but the exact opposite has happened, which is the consumer is cash flow rich, like as rich as they have ever been. Because the CARES Act has really allowed that. It's allowed people who have lost their jobs to put off paying large expenses like rent, mortgage for up to 6 months and even up to 12 months, okay? Meanwhile, backfill their income with unemployment plus an additional, no questions asked, $600 a week federal bonus.
Wow.
Actually, the majority of people claiming unemployment checks today are making more than they would if they were working.
Mhm.
And this is, I mean, this is good for the people from an economic view. It's not that great. But when you have all this cash flow, you have this glut of cash, but you have to remember that all these mortgages and rents that were put off in forbearance, well, they're due in full in 6 months, which is about April. They're due in full on day one. Otherwise, otherwise evictions start happening. The CARES Act PPP program expired in June. Um, and in August, we don't $100 a week in federal unemployment benefits is going to still be there for everybody. It only lasts till July 31st. Now, I'm sure they'll come up with some package, and the latest news is that Senate is passing a bill where people making under 40,000 will be eligible for it, whereas everybody else. But we're coming up to a point where there might be extraction market, and we'll have to see what happens. So
Mhm.
this is unlike any recession we've had before. People are cash rich. Nobody is feeling hardship at all, which is probably why the stock market has done so well on all the new money, and the economy will be better.
Well, I mean, we've all seen locally small businesses are going out of business. People are losing their jobs. So there is obviously a economic hardship of some sort hitting people. Just kind of the short-term sting has been taken away.
Yeah,
uh, in a
section,
lot by these checks. Yeah.
once the checks end and people need to go back to work, well, that's 36,000 less people that can go back to work at United Airlines, right? 700 people less that can go back at Levi's. And there's been 69,000 layoffs even in the technology sector, one that you wouldn't think is hit. There's been 69,000 that probably aren't going back, once so there might be a reckoning coming, but we'll see. They may be passing more fiscal stimulus, which I shouldn't say maybe they will. They will be passing more fiscal stimulus to get us through. And yeah.
Great. So, given all of that, we talk in these videos a lot that we're intentional about what we invest in. We're not chasing things, but we're also people that follow our trades and in our clients that are in our strategies will see that we're not actively selling off or getting any more conservative really than we have been over the last few months. And I know that's because our many of our strategies are hedged to protect on the downside, and because we're so focused on investing in companies, as you put it, with real equity value, not necessarily hype or riding the wave as much as possible, but companies that we believe have a true value, are light on debt, so that if they do have to take some on, they're still not highly leveraged. And I think a couple of the ads this week that maybe point to that are some individual names we added to in emerging markets and more kind of the industrial sector. Anything you specifically want to discuss there?
Yeah, specifically to your hedging point, and the question is, what are we really hedging against?
Mm-hmm.
You know, like I said, we're expecting more fiscal stimulus to come. So far this year, in 2020, our fiscal deficit is 0.7 billion. Never been past 1 billion for the past 3 years, so we're blowing out money, and the next package might be another. So all this money, I mean, it has to come from somewhere. Well, the Fed is going to print that money. Now, if you live in Venezuela or Zimbabwe, where you are not, bread goes to $1 million.
Sorry, John, cut out for a second there. Tell me, if you're in Venezuela or Zimbabwe, say that again.
It's unfortunate that you live in those countries, because if you did what the United States was doing, then the price of bread goes to $1 million.
Right.
But luckily for us, we have strong influence across the world. We have friends everywhere, and they rely on us. So they use the U.S. reserve currency, which means that we're able to run a federal deficit for as long as my lifetime without any real consequences. Now, a lot of bond managers like this as a scare story, probably to get people into their asset classes.
Mm-hmm.
It's a very existential question that isn't something think about as an immediate threat, but it is a risk we should keep in the back of our mind, especially given the situation we're in, where we're blowing our federal deficit 5, 6, 7 times higher than we've ever done.
Right.
Stimulus, the amount of money we are printing is just enormous. If we were any other country, we would be in, but we're not. As I said, because we have friends across the world on us.
Reserve currency.
Right. But that's also the risk. If you look at where the United States has been heading over the past couple of years, we've been cutting our ties. We've been cutting our friends are not really our friends anymore. Becoming harder and harder for developed countries to run. So the question becomes, if we continue on this trend, how strong is the U.S. dollar, and how welcome is that reserve more? I'm not saying things are going to flip in one day, but I am saying that we may be at the peak, and it may be a slow ride. It may be a slow ride in the other direction.
Mm-hmm.
Fed cannot manage all this stimulus that's going in. So, one of the hedges we added is gold, which is a hedge against all the currencies. And, hopefully that as a hard asset with a finite amount will retain its purchasing power no matter what happens.
Yep.
And in emerging markets where countries are the pandemic than the United States are, and in companies with real equity, because if you look at all the large cap companies, a majority of them are taking on a lot of debt during this period. So they're going to come out the other side more leveraged. And what you're going to see in 2 years is you're going to look at a that's trading on with an 80% debt to equity ratio. You're going to have to ask yourself, is this company really have any equity value business, or is it 100% debt? So equity value is going to be hard to come by. Investors are going to be fighting for it. We're seeing that already with all the high growth technology stocks and healthcare stocks just screaming out. That's all anybody wants to own, because that's any real equity value. So we've been adding there too, and I think as the market presents us with opportunities in the next couple months, we will be adding more.
Great. All right. Thank you, Jonathan.
Thank you, Lauren.
Appreciate your insight, everybody. Thank you for joining us. Look forward to our quarterly letter coming out this afternoon. And as always, don't hesitate to reach out with any questions. Hope everyone has a great weekend. Bye.